Good morning. Welcome to Good2Know Talk Series, where our focus is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. With us this morning, we have our co-host and today's speaker, James Kong. James is a financial advisor at Edward Jones, and his office is in Kaka'ako. James works with small businesses, individuals, and families to identify their risk and develop strategies to help them reach their short, mid, and long-term goals. When he's not working, James plays competitive beach volleyball. He used to serve as volunteer assistant coach for the UH Wahine volleyball team under Dave Shoji, and currently serves on the Young Leaders Board for the Make-A-Wish Foundation, American Heart Association, and is also a board member on the Kamehameha Schools Alumni Association. And he's my trusted source for information in the industry. James, good morning. How's it going? James, we can't hear you.
Actually, there, now can you hear me?
Oh, okay, yeah, there you are.
Okay, good morning, everyone. Thanks for having me, Janean.
Yeah, before we get started, for our listeners, if you have any questions during the presentation, you can type them in the chat box on your screen. And at any time today or even during the week, you can email us at info@smarttaxhawaii.com if you'd like more information. Let's see, so let me switch this over to you, James.
And let me know if you can see my screen.
Yes, I can see it. Yeah, James, last week we discussed inflation risk and its importance in developing your financial plan. So what's next? How do you beat inflation?
Yeah, so I'm going to make it specific to business owners, and kind of inflation risk and also business risk kind of work hand in hand. So for those that tuned in last week, there's going to be a little bit of rehashing of information. And for those that are just tuning in this week, if you do want the slides from last week's presentation, just let myself or Janean know. So as we hop into it, just understanding the basics of inflation. And inflation is just the general increase in prices of goods and services and the fall of purchasing power over time with money. And so the long-term percentage for inflation is roughly 3%. So what does this mean today? And based on a low interest rate environment where I'm earning 0.02% in interest in my Banco account, it's very difficult over time for budgeted savers and investors to maintain their purchasing power. Okay. So when we talk about our 3-bucket strategy, if that's new to some of you listeners, you can refer to the other presentation, and I'll go over it later in this presentation. But the function and the benefit of utilizing your checking and savings is to minimize, actually eliminate your principal risk. So people utilize their checking and savings account not to earn interest. It's really to protect the principal over time, because that is going to be bank insured, and whether a business owner needs their money today, tomorrow, a month, a year out from now, it's guaranteed to be there. So for business owners in that infancy stage, it's very important to create that solid foundation, because I'm sure everyone's experienced there are hiccups along the way when establishing a business. So you just want to have that safety net there just to fall back on. And so a good rule of thumb and a strategy that I recommend to some of the business owners that I work with is to keep at least 6 to 12 months worth of liquid cash and expenses. Based on monthly cash flows, this may vary. So if you're maybe for realtors or maybe for other businesses that don't have a consistent cash flow, they may want to err towards the higher end of 12 months just because cash flows are uncertain. And so basically, calculate the cost of labor, wages, goods and services, transportation, etc., and multiply that monthly amount by 6 or 12 to get that amount you should be keeping liquid in cash. Okay. And so business risk. So over time, what do we need to do as business owners to maintain our purchasing powers and compete with our competitors? Okay. And essentially, business risk, similar to inflation risk, is understanding the rising cost of goods and services, but for your specific business. So as I've worked with local business owners, I've worked with them to determine what's the rising cost of goods and services in their specific industry. And here are some specific examples. Okay. Construction, it's usually 4% year over year. For dental supplies and equipment, 6%, medical equipment and supplies, 5%, and then painting supplies, 4%. So this is obviously going to vary. So, as a business owner, you need to do a little bit of homework to ensure year over year for you to maintain your purchasing power, what's that number? And so a good strategy that I recommend, and it's going to, again, vary from business to business, is determine what financial goals and objectives you have within a 5-year time frame, okay? And, with that, you're going to consider investing in fixed interest investments that potentially can close or reduce the gap between what interest you're earning in your checking or savings versus what your money needs to grow at to maintain with your business risk or maintain with inflation. And some of you are probably asking, what are fixed interest investments? And so really understanding fixed interest investments and how it works. So essentially, when you're receiving a fixed amount of interest, you're allowing someone to borrow your money, whether it's an institution or a business, and in return, they're paying you a fixed interest. Oftentimes, the shorter the time frame in which they're borrowing your money and the more liquid the asset is to you, the lower the interest will be paid. So the prime example of that is our savings account. Okay. Oftentimes, the longer you allow the institution to borrow your money, the more illiquid it is to you as the individual or business owner, the higher the interest will be. So oftentimes you look at corporate bonds or municipal bonds, that term or maturity may be 5, 10, 15, or up to 30 years, in which the cost or the trade-off is that you're going to get paid a higher interest, but in turn it's going to be less liquid to you. And sometimes the more risk involved, whether it's a small company or whether it's maybe a municipality that doesn't have a good credit, the higher interest would be paid. So that, that institution is taking on more risk, and so they're having to charge, a higher interest. And prime example of this is credit cards. So banks do credit check, credit history, and if they're taking on more risk, they're going to charge a higher interest to let somebody borrow money. Okay. And so specific types, and these are rates, local rates. So if any business owners want to look at mainland rates, Edward Jones brokers out to mainland banks, but this is at First Hawaiian Bank. So 1 to 5 years, you're looking at 0.13% or 1.25% for 5 years. Corporate bonds in the range of 2.5% to 4%. Municipal bonds, which sometimes can pay either federal or state tax-free interest, it's 2 to 5% depending on the maturity, and bond funds will vary between 1 to 6%, again depending on maturity. Okay, So really, I think people are tuning in to say, James, what are opportunities that I can increase my purchasing power and have my money working for me? And there is, with that comes investment risk. And so investments and portfolio value will fluctuate based on economic factors, law and policy changes, interest rates. And so it's usually recommended that there's a buy and hold strategy to reduce timing, market timing. And then again, investment return potential can help to keep up with rising costs of goods or your business risk and improve purchasing power over time. And it's very important that people realize that there's a reason why I put investment return potential, because returns aren't guaranteed year over year. It's going to fluctuate with the market. And so, when determining an investment strategy, I'll ask clients to look at a time frame 5 or years out from now. And so when they invest, they're looking at growth-oriented investments that can help to increase their purchasing power over time. And as I mentioned, that value may fluctuate over time, but based on low interest rates today, it is something to consider to reduce your business risk over time. That's the biggest worry that I have as a personal saver, budgeter, and investor, is just keeping up with inflation over time. And so just going over 3 different types of basics, and I don't want to take you guys too far out into the woods. And this may be knowledge that you folks already have. But the first is stock. Investing in an individual company, so you own shares in that business. You are a part owner of McDonald's, Starbucks, Amazon if you invest and acquire shares. Mutual fund is a group of companies that will help you to diversify your risk. And the investment returns will be the aggregate return of all the companies within that mutual fund. An ETF is similar to a mutual fund, but it's not actively managed. And so the best way that I can kind of tie in those 3 types of investments is using a swimming pool analogy. So if you were asked to have 40 swimmers in the pool, and in the context of a stock, you'd have to pick that best swimmer that could tread water the longest, okay? So within those 40, you have to pick the best one, okay? In a mutual fund, picture it as you can bet on the entire pool, and you have a lifeguard to ensure that if there's any swimmers that drown or any companies that are failing, that they actively remove that company and put in a new swimmer or company, okay? An ETF simply is a fixed pool with no lifeguard. You're betting on the pool, so you're going to take the aggregate return of every company in that pool, but as some start to fail or drown out, you're stuck with that those fixed companies in that pool. Okay, so hopefully that makes some sense to you. So from last week, we looked at the purchasing power continuum. So it's important to understand that the gap between interest rate at the bank and inflation, this is inflation risk, and oftentimes it's more so, or the gap is even larger between your specific business risk or the rate at which your money needs to earn over time just to maintain its purchasing power. So again, realizing and using a golf analogy that your business risk should be par. So in the context of dental supplies, 6% is par. Anything over the long haul that's not earning us 6%, we're losing purchasing power. Anything that gets in excess of 6%, we're able to increase your purchasing power. And so real quickly, and this is in the last presentation, so if you want this slide, these slides are the last one, but this is just offering some guidance in terms of developing a monthly budgeting strategy. So essentially determining what comes in terms of monthly income, what is spent in terms of expenses. If you have a surplus, you can determine how to set up a strategy to balance your principal risk, your business risk, and also your market risk. So on a monthly basis, I work with a lot of business owners that create a corporate account or dependent upon their entity. And then on a monthly consistent basis, they fund each bucket of money to balance and diversify their risk. Okay. Janine and myself get a lot of questions and say, James, I don't have time. I need money now. And it's important to realize that not all debt is created equally. And the main question I would ask yourself is, can your return on your investment keep up with or outpace the interest being paid to borrow money? So the examples of this may be retail expansion, hiring additional staff, increasing production. So essentially, the return on the investment, in my opinion, needs to outperform or at least keep up with the interest being paid. Can debt be good? You'll probably have a conversation with Janine with mortgage. So right now, the way that taxes are situated, that we can get a deduction with your mortgage. So oftentimes I'll have clients look at the interest rate, and if they refied in the last 3 years, they can maybe use those additional cash flows to get an excess returns of the 3.5% or maybe 4% they're paying for their mortgage and maintain that deduction. So determine the tax benefits or the considerations when taking on debt. And so real quickly, and I'm sure people know these figures, car loans, fairly low, mortgage, same, credit card, that's when you're getting into kind of a realm or area that investment returns most likely aren't going to keep up with credit card interest rates. Okay, so again, ask yourself, what's the return on investment? And is it able to exceed or keep pace with the interest you're paying? Yeah. Real quickly, 401k loans, you need to determine if your company allows for that. So check with HR to see if your plan allows for it. 401k distributions, work with Janine to determine what's the withholding amount you're going to have. And then distributions from cash value life insurance policies. Consult with your financial advisor to ensure that if you take distributions from cash value policies, that the policy doesn't collapse and you potentially lose coverage. Okay. Again, consult with your tax professional, especially with retirement accounts like 401k, SEP IRA, traditional IRA. It's best practices to replenish or refund those accounts as soon as possible so you can maintain that retirement nest egg. Key points from today, I just kind of narrow it down to these 4 things. Understand your company's business risk. It's going to vary across the board, so really determine what's your business's par. Develop a monthly budget strategy so it's not really putting in lump sums over time, that you're just taking one small bite at a time as you're working to balance and diversify your risk. Look at the numbers. Determine what's the rate of return and what is needed to maintain your business's purchasing power over time. And lastly, if you do need to borrow money, obviously do the math and see how your rate of return is going to compare to the interest rate that you're paying. So if you have any questions or concerns, I think someone may have chimed in for a couple questions, but because I'm sharing my screen, I can't see those. So Janine, if there's a way that you can see those questions and I can address them, or we can follow up.
Yeah, one of the, going back to the expenses, how did you come up with those percentages for the dental supplies?
Yeah, so they'll usually work with whatever vendor or distributor and just look at their books year over year to determine, and you can be as detailed as you want, but I'll just, I'll have the business owner do their homework and determine what's the increase year over year for cost of goods and services. So for those specific dentists, painting company, whatever it may be, really finding out what's the average increase year over year.
Okay, so it's not for all expenses, it's just their cost of goods.
Yeah, cost of goods. And then again, if they do projections based on, for staff or employees, if they want to keep with a certain annual increase in wages, what that may be. But I think the easiest place to start is usually looking at equipment, technology, or services and what that needs to grow over time. But it is going to vary. Any other questions?
No, that's all the questions I'm seeing.
Okay. And if anybody has any follow-up questions that may be specific to your industry or your specific scenario, please feel free to reach out to myself or Janine. I'm really just, I think the turning point for a lot of business owners, including myself, is just understanding, inflation and business risk based on a low interest rate environment. So as interest rates remain low and our ability to try to keep purchasing power over time, we really need to develop a strategy just to compete and then also to grow our businesses.
Yeah, thanks, James. Is there, interest rates are low now, but, if interest rates were to rise, would you have to revamp, the whole financial strategy, or is that just something you just kind of keep an eye on in working with clients?
Me and my clients are going to have to keep an eye out on is that the ability to borrow money is going to be more costly to the consumer of the business. So there's going to be a squeeze in terms of, our ability. So once interest rates and people are looking at mortgages and go to 4.5%, 5%, 5.5%, 6%, then that makes more of a strain in terms of investment return that you can get in excess of that par. So it's going to be more difficult as interest rates rise, but people like the banks are going to make more, and that's how they make money. Is that, with my savings account, I earn 0.02%. Janine gets a mortgage at 4.5%. They make that spread, and that's how they make money over time. But yeah,
there's a question coming in. What is a smart year-to-year increase or average, and what is too high, if at all?
Increase or average in Okay.
So, I don't know if it was just my microphone, but I didn't hear that. Could you answer that question again?
Yes, I wasn't sure what specifically that listener was talking about in terms of increase.
If it hits over 5% year to year, is that too much of a growth per year?
Oh, good. Yeah, it's really a great question, and it's really dependent upon what risks that business owner is willing to take on, because no matter what, we're always going to be susceptible to some type of risk. So if they're looking for more security, maybe a CD strategy is going to be protect their principal more so, but that is going to create a larger gap or spread between what their money needs to earn based on their specific business. If they're in an industry that average cost of goods year over year is 6%, 7%, 8%, that's going to be very, very difficult. And there is going to be some type of investment risk to take on due to that big spread between what we're getting in cash or savings versus what. So yeah, great question.
Mm-hmm. Let's see. What do you suggest for a smart year-to-year increase to maintain?
Yeah, it really depends on the growth of the business. And I think the easiest way to determine that is look at monthly surplus. So, in those businesses in the infancy stage, work to get that solid foundation of 6 to 12 months worth of expenses, liquid and cash. And then anything in excess of that, you could utilize to reduce your business risk in that second bucket. And then, potentially increase your purchasing power in that third bucket. So it really depends, and it's not one silver bullet, one size fits all. You just have to be responsible at looking at monthly cash flows. So a lot of business owners will look at their last 4 months rolling to determine that average, and expenses for the most should remain fairly consistent. And then just being disciplined with taking whatever surplus amount there is and then, investing and allocating it to balance out your risk.
Yeah, and when we work with our clients, we're looking at how to save them on taxes, which is often their biggest expense. So that will help add to their surplus. So you can work their numbers that way too.
Yeah, and I think you do, obviously a great job of working with clients and really determining a strategy. And there's different types of investment. Retirement nest egg while generating deductions at the same time. So advisor is going to work, utilizing the tax expertise, the EA or CPA, and really to maximize tax deduction or tax benefit, and then maximizing assets for the business.
Well, we are at the end of our time today. If we didn't get to your question or you'd like more information about today's topic, please send us an email at info@smarttaxhawaii.com. Thank you, James. As always, we look forward to next week, same time, same place. Have a great week, everyone.
Thanks, Janean.
Thanks.